Why you always sell winners too early but hold losers until your account blows up. Here's a question that haunts every trader. Why do brilliant professionals, people who crush it in their careers, turn into absolute fools the moment they open their trading app? You buy a stock at $100. It climbs to 108. Your finger hovers over the sell button. You cash out. 8% gain. You feel smart. You feel safe. Then you buy another stock at $100. It drops to 90, then 80, then 70. You don't sell. You can't sell. You tell yourself it's a long-term hold. You check the price every hour. It hits 60, then 50. You're still holding. Your account is bleeding, but you refuse to cut. This isn't bad luck. This is behavioral finance in action. The market operates on mathematics. Cold, logical, predictable in its unpredictability. But humans? We operate on evolutionary instincts built for survival, not for wealth accumulation. And that clash, that fundamental disconnect between financial logic and human reality, is exactly why most people stay poor. Today, we're going deep into the psychology that destroys portfolios. We'll examine the cognitive biases that make you your own worst enemy. And I'll give you practical solutions, proven strategies to rewire your decision-making process. Let's begin. Every trading book will tell you the same thing. Cut your losses short. Let your profits run. Jesse Livermore said it in the 1920s. Benjamin Graham echoed it decades later. It's the golden rule of wealth management, and it's mathematically perfect. If you risk $1 to make 3, and you're right just 40% of the time, you print money. The math is simple. The execution? That's where humans fall apart, because here's what actually happens. You make 10 trades. 7 are winners. 3 are losers. Sounds great, right? But look closer. Those 7 winners average 8% gains. You cashed out fast, took the dopamine hit, moved on. Those 3 losers? Negative 30%, negative 40, negative 50. You held them because you couldn't accept the pain. Net result? You're down. This phenomenon has a name. Prospect theory. Developed by Daniel Kahneman and Amos Tversky in 1979. It won Kahneman the Nobel Prize in economics. Here's the core insight. The pain of losing $100 is approximately twice as powerful as the pleasure of gaining $100. We are not rational calculators. We are loss-averse creatures. Evolution wired us this way. 10,000 years ago, losing resources could mean death. Gaining extra resources? Nice bonus, but not life or death. So our brains developed an asymmetric response. Losses hurt more than gains feel good. Much more. This asymmetry is the root cause of every blown account you've ever seen. In 1985, 2 researchers, Hirsch Sheffrin and Meir Statman, published a groundbreaking study. They analyzed thousands of trades, and they found a disturbing pattern. Investors were selling winners at a significantly higher rate than losers. They called this the Disposition Effect. But why? It's not stupidity. It's cognitive dissonance. When you sell at a loss, you're doing more than closing a position. You're admitting you were wrong. You're accepting that your analysis failed. Your judgment was flawed. Your ego takes a direct hit, and human brains hate being wrong more than they hate losing money. So what do? We hold. We rationalize. We tell ourselves stories. It's a temporary dip. The fundamentals are still strong. It's a long-term investment. Let me give you a concrete example. You buy stock A at $100. Solid company, good research. You're confident. 6 months later, it's at 70, down 30%. Here's the question. If you had $70 in cash right now, would you buy this stock? If the answer is no, Why are you holding it? Because selling means admitting the initial decision was wrong. And that admission is psychologically more painful than watching your capital evaporate. This is the disposition effect, and it's destroying your financial freedom. Let's break down the specific cognitive biases that keep you trapped. First, anchoring bias. You bought at 100. That number is now your anchor, your reference point. Your brain treats it as meaningful, as relevant. But here's the truth. The market doesn't care what you paid. The price you entered is completely irrelevant to future price action. It's noise. But to your brain, it's scripture. You watch the stock drop to 80. You think, I'll sell when it gets back to 100. You're anchored, and anchors drown portfolios. Second, mental accounting. This one's subtle. When you're up 8%, you categorize that gain as market money, not real. Easy come, easy go. So you cash out fast, lock it in before it disappears. But when you're down 30%, that's your money, your hard-earned capital. You have to protect it. You have to fight to get it back. So you hold, you double down, you average down, same dollars, different mental buckets, different behaviors. Third, sunk cost fallacy. Arkes and Bloomer studied this extensively. People continue investing in losing projects simply because they've already invested. The past investment is sunk. It's gone. It shouldn't influence future decisions. But it does. You've held a stock for 2 years. It's down 40%. You think, I've come this far. I can't give up now. That's sunk cost fallacy. You're throwing good money after bad because of money that's already lost. These aren't character flaws. These are hardwired cognitive biases. Everyone has them. The difference between successful investors and broke investors: successful ones build systems to bypass their own brains. So how do you fix this? You can't eliminate bias, but you can neutralize it. Here are 3 actionable strategies. Proven frameworks for decision-making that bypass emotional intelligence traps. Strategy 1. The rule-based system. Stop making discretionary decisions. Build rules. Follow them religiously. No exceptions. Example: trailing stop loss. You buy at 100. You set a trailing stop at 8%. If it drops to 92, you're out automatically. No debate, no negotiation with yourself. If it climbs to 120, your stop moves to 110. You've locked in gain. You've eliminated the temptation to sell too early. Rules remove emotion. And emotion is your enemy. Strategy 2. The clean slate method. Every day, ask yourself this question: if I didn't own this stock and I had cash, would I buy it right now at this price? If the answer is no, sell it immediately. This mental reset breaks the anchoring bias. It forces you to evaluate current value, not past decisions. It's cognitive behavioral therapy for investors. Strategy 3. Redefine failure. Cutting a loss is not failure. It's risk management. It's part of systematic approach to wealth building. Professional traders, the ones with proven track records, lose on 40 to 50% of their trades, but they make money because their winners are bigger than their losers. They understand that losses are the cost of doing business. You need to internalize this. A stopped-out trade is not a mistake. It's a data point. It's tuition paid to the market. It's part of the process. Once you reframe cutting losses as professional discipline rather than personal failure, the emotional barrier disappears. Let me leave you with this. Investing is not a battle between you and the market. It's a battle between 2 systems in your own mind. Daniel Kahneman called them System 1 and System 2. System 1 is fast, emotional, instinctive. It sees a loss and screams, "Hold until you break even." System 2 is slow, logical, analytical. It calculates expected value and says, "Cut and reallocate to better opportunities." Most people let System 1 drive. That's why most people lose. The metacognitive investor, the one who builds real wealth, learns to recognize when System 1 is hijacking the controls. And they override it with rules, with discipline, with self-awareness. This is not easy. Behavioral psychology tells us that self-discipline is a muscle. It gets stronger with use. Start small. Build your rule-based system. Track your decisions. Review them weekly. And here's my challenge to you. Drop a comment below. Tell me about the biggest loss your ego caused. The trade you held too long because you couldn't admit you were wrong. No judgment. Just data. Let's learn from each other. Because here's the final truth. Investing is not about beating others at their game. It's about not being beaten by your own brain. If you found value in this deep dive, subscribe for more insights on financial optimization and investor psychology. Next week, we're breaking down the neuroscience of peak performance in high-stress decision-making. Until then, cut your losers, ride your winners, and remember, the market rewards the disciplined, not the hopeful. See you in the next one.